Warren Buffett is one of the most successful investors in history, but many people don't know that he made some of his biggest profits during times of high inflation. This video will show you how you can follow in Buffett's footsteps and invest your money through these tough times for sky-high rewards. First, being awake to the reality. The 1970s were a challenging time for investors. The period was known as the Great Inflation, marked by skyrocketing prices and interest rates. Despite these challenges, Warren Buffett achieved impressive returns during this time. How did Buffett succeed where so many others failed? One of the key reasons is that he remained grounded in reality. Buffett did not allow himself to be swayed by emotion or speculation. Instead, he focused on the fundamentals of the businesses he invested in. This approach is just as relevant today as it was 40 years ago. In an environment of high inflation and market volatility, investors must focus on the long term. Investors can come ahead even in challenging times by keeping a cool head and staying true to their investment strategy. It is a lesson we can all take from Warren Buffett's successful navigation of the Great Inflation. Next up, staying the course. It's been said that death and taxes are the only two things in life. While this may be true, it's not the only thing you can count on. You can also count on the stock market going up over time, as it has done for centuries. This is called the historical average. However, there will be times when the stock market goes down. This is called a market correction. When this happens, don't panic. The best thing to do is stay the course and keep investing in stocks. Over time, you will make money if you don't sell your stocks during a market correction. On the flip side, don't get caught up in the hype and overinvest during market growth and high stock prices. Stay disciplined and stick to your investment plan. This way, you won't be tempted to sell during a correction and miss out on long-term gains. Warren Buffett faced numerous market corrections throughout his investing career and stuck to his investment strategy. He stayed the course, investing in quality companies for the long term, and was able to come out ahead during times of market uncertainty. And lastly, building wealth Warren Buffett style. Warren Buffett is a name that is synonymous with wealth. The Oracle of Omaha has been building his fortune for over 50 years, and he is now considered one of the world's richest people. But how did Buffett become so successful? What are his investment strategies? And what can we learn from him during these challenging times? One of Warren Buffett's key investment strategies is to buy stocks when they are cheap. During periods of high inflation, like the 1970s, this cannot be easy because stock prices tend to rise along with prices in the overall economy. However, Buffett succeeded by investing in companies that could grow their profits even during times of high inflation. Another aspect of Buffett's success is his long-term approach to investing. He has famously said, "Our favorite holding period is forever." Instead of jumping in and out of the market, Buffett looks for solid companies he can hold on to for years or even decades. This allows him to ride out market ups and downs and ultimately see greater returns in the long run. In addition to selecting strong companies, Buffett also values good management. He stated that he looks for honest and competent CEOs with a track record of making smart decisions. He also prioritizes businesses with a durable competitive advantage, such as a strong brand or patent protection. Warren Buffett's investment strategies can be summed up as buy and hold, selecting quality companies with strong management and long-term potential. It may be tempting to make quick trades for short-term gains in a volatile market, but taking a page from the Warren Buffett playbook, investing for the long run can lead to greater success. 3 Warren Buffett inspirational quotes. Firstly, take advantage of volatility. Volatility provides opportunities for investors who are willing to act. When markets are volatile, prices move up and down more than usual. This means there are more buying and selling opportunities than in less volatile markets. Because prices move around more, it is also easier to find bargains. Stocks trading at lower prices than they should be, and overpriced stocks trading at higher prices than they should be. For these reasons, volatility can provide profitable opportunities for investors willing to act. But it's important to remember that volatility can also be risky. It is important to have a well-researched and diversified investment strategy and not to let emotions drive decisions during volatile times. As Buffett famously said long ago, Ben Graham taught him that price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. Buffett often speaks of his bafflement that investors seem to panic when shares are cheap rather than treating a sell-off like the Boxing Day sales. The cheaper you can buy a quality company's shares, the greater your returns will be. Many of Buffett's most lucrative buys have been executed during market crashes. Suppose you are happy buying a quality company for $100 a share when investors are in an optimistic mood. In that case, you should be overjoyed if a market crash sends that same company down 50%. There are caveats to this. We should be far warier if investors send a company down for a good reason, for example. But remember that Buffett's favorite time to buy is when everyone else is selling. Meanwhile, Buffett buys the the company, not the trend. Investors can assume that if a company is part of a successful industry or emerging trend, then its shares are somehow automatically destined for greatness. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. Warren Buffett is one of the most successful investors in history. He made his fortune by buying companies, not following trends. Buffett's strategy is more relevant than ever when so many people are trying to time the market. One of Buffett's key principles is to buy businesses, not stocks. When you buy a stock, you buy a piece of a company, but when you buy a business, you're buying the company itself. That's why Buffett can make such profitable investments. He buys undervalued businesses with the potential for growth. In recent years, we all saw this play out. For example, in the buy now, pay later BNPL space. We all know that BNPL grew phenomenally as a preferred payment method, and yet it seems investors were convinced for a while there that all BNPL shares were worthy of massive share price appreciation. The sector has now come back to earth and, arguably, exposed this fad for what it was in the process. It turns out that most BNPL shares didn't have anything close to what Buffett would call a competitive advantage. Trends come and go, but good businesses will always be in demand. So if you want to invest like Warren Buffett, focus on finding great companies rather than jumping on the latest bandwagon. Finally, forget the crowd. It's easy to get caught up in the crowd mentality, especially when it comes to investing. After all, who wouldn't want to make money by following the herd? But as Warren Buffett has famously said, be fearful when others are greedy and greedy when others are fearful. In other words, don't invest based on what everyone else is doing. Instead, invest based on your analysis and research. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Following the crowd is a bad idea because it's usually led by emotion rather than reason. When everyone buys a stock because they think it will go up, greed drives the investment. And when everyone is selling a stock because they think it will go down, fear drives the investment. Neither of those emotions is good to rely on when making an investment decision. We can all be guilty of obsessing over the day-to-day gyrations of the share market. The ASX 200 is up 1% one day, down 0.5% the next. But all we are doing here is reporting on what the crowd is doing. Buffett is famous for not worrying about the daily moves of shares. So how do you overcome the temptation to follow the crowd? Doing your research and forming your own opinions about a company or stock. Don't just listen to what other people are saying. Look at the numbers and try to understand what's happening with the company. That way, you can make an informed decision rather than simply following the herd. Warren Buffett is one of the most successful investors in history. He doesn't invest based on trends or what everyone else is doing. He invests based on his analysis and research. And that's something we can all learn from. When investing, don't follow the crowd. Do your research and form your own opinions. That way, you'll make informed decisions rather than following the herd. Thanks for watching. If you liked this video, like and subscribe to our channel for more videos like this. And don't forget to leave a comment below, letting us know what you think. We love hearing from you.